Roger Lee is head of UK equity strategy at Investec. Roger, I'm going to let you into a little secret. I was literally distracted there and I didn't know my link was coming because I am in contact with a very good friend of mine and his CIO on WhatsApp now talking about inflation. That's how my life rolls when I'm not on camera as well, and how it could be affecting strategy and what have you as well. Roger, what's your view on this? I keep seeing reams and reams and reams of inflationary data that everyone keeps telling me, well, from a policy perspective, it just doesn't appear too permanent as well. Do you agree? It's just transient?
I think it's good morning, and thank you for having me on your show again. But I think it's increasingly difficult to keep describing this as transitory. And in fact, what was so interesting this week, and really perhaps what turned the market on Monday, was the acceptance letters from Powell and Brainard. Neither of them mentioned the words transitory, temporary, or patient. So it looks as if the central banks are beginning to get the idea that this isn't transitory. And there's a very simple reason, and I haven't got a PhD in economics here, but there's a very simple reason why inflation isn't transitory, and that's just simply because the money supply that's been printed during the pandemic, particularly in the US and also in the UK and in Europe, but the money supply in the US has gone up close to 20%. The growth in money supply, the growth in M2, was up 20%. And so it just stands to reason that if there is 20% more money in circulation, very simplistically, then money should be worth less. The pound in your pocket is worth less. The dollar in your pocket is worth less if there is a fifth more of them in circulation. And that's the problem facing policymakers. And your guest that you have frequently in the US, Professor Siegel from Wharton, frequently refers to this. It's about money supply. That's what's driving inflation. The supply issues, they are just adding to it. They are just exacerbating the problem. But the fundamental problem at the moment is we have too much money chasing too few goods, and that's inflationary.
And what about that money which is chasing too few stocks as well? Because not only have we got pumped up valuations, but we also got this perpetual mantra of de-equitization. I looked at the US buybacks over the last quarter. We are in record territory, Roger, as well. So what does it mean for equities? I mean, in some ways, equities could be good if we're seeing some form of inflation. But in other ways, I just wonder about your premise about too much money chasing too few assets.
Well, it comes back to the ultimate distortion, and it's all connected. The buybacks are connected to this, the valuations are connected, the extreme valuations in part of the markets. They all come back to one number, and that is real yields. Now, real yields are a fairly arcane part of the market, and they don't get enough attention as they do, but it's real yields. Now, they are the inflation-adjusted cost of borrowing, simplistically, the inflation-adjusted cost of money. And real yields, as we speak today, are at record lows, minus 1% today, and that is a 40-year low. The only other times real yields have been as low as this have been during other periods of QE in 2013. So it's these real yields that are distorting behaviour because the cost of money is too low. And that is leading to buybacks, as you say, because the cost of debt is being distorted. It's leading to excessive valuations because the cost of money is being distorted. And so it ultimately comes back to these real yields. And these real yields are being distorted by QE.
Roger, can I ask you about the markets then into year-end? Because if you look at some of the core European markets, you can see they've had a very strong run-up over the past month or so, but just started to come off some of those highs. But then there's been a bit of a split with the FTSE, which has not had as strong or confident as run, but just is also trying to show a little bit of resilience at this stage in the face of that sell-off elsewhere. Is this just all COVID-related, the market judging that Europe might be going into some form of a COVID situation, whereas immunity perhaps is stronger here in the UK?
Well, I'd like to think so. I think it's perhaps more to do with the construct of the FTSE rather than necessarily COVID, because the leisure stocks in the FTSE have been equally affected as they have been across Europe on the concerns of increased lockdown. But one has to bear in mind that the FTSE is predominantly the FTSE has an overweight in oil, something like 9% compares to MSCI World of closer to 2-3, and it also has an overweight in financials. And as yields rise, as the market rotates, then clearly the FTSE benefits because those particular components benefit. And it also comes back, the FTSE has been underperforming since Brexit in 2016, so maybe it's due a bit of a bounce.
Roger, then if we can talk about some of the market volatility that could lie ahead, because there is a feeling that once we get past the debt ceiling issue on markets and how that could have a monumental impact on yields, you may get some more volatility out there. Do you agree? Do you think we're setting up for a rough start to 2022?
It's difficult to imagine that we're not. And it basically comes back to this problem, the dilemma that central banks are faced. You know, we talked about these real yields. QE at the moment is ongoing. There is still $105 billion worth of QE being government bonds and mortgage-backed securities that are being bought every month. In the UK, we are still pursuing QE, and that is suppressing these real yields. And these real yields are being suppressed to stimulate the economy. So we are pursuing a monetary policy that is stimulating the economy at the same time as central banks are concerned about record inflation. It just doesn't make sense. You cannot have a stimulated economy at the same time as central bankers are concerned about inflation. So something has to give. So either inflation is going to come down, which we doubt, or QE has to stop. Now, when QE stops, then you can see how much these real yields have been suppressed, and we could then see another taper tantrum.
Yeah, Roger, I was just going to ask you, because you've looked at tantrums, you've also looked about markets distortions and when they are the most stretched, and you've highlighted 1999, 2000 in your copy, but one could go back and many times. I mean, ERM, 1997, East Asia, 1998, LTCM, Russia, and the great financial crisis itself as well. Are we due some form of aggressive downtick, or actually did the COVID decline of early 2020 take out the real impetus for a big clear out?
I think it's difficult to sort of say whether one's due or not, you know, that these things have to come every 7 years, which I know is a sort of a bit of an old market saying, but due in the sense that valuations are very stretched, yes. Valuations are very stretched. We've talked about this before, the number of stocks that are trading above 20 times, above 10 times. We've talked about the distortions that are across the market, particularly in some of these highly valued industries and sectors. So in that sense, we have got conditions that are very similar to when the market has become very stretched in the past. And what's different, I suppose, about this time, what is different about this is that we have a central bank policy that is very supportive of those distortions. And so when those central bank policies change, and in fact reverse, then those distortions should correct. And that could be painful.
Roger, always a pleasure, sir. Thank you very much indeed for joining us. Roger Lee, Head of UK Equity Strategy over at Investec.